Morning, everybody. The April 6, 2021 School Land Board meeting will now come to order pursuant to the governor's executive order to avoid gatherings of more than 10 and the governor's March 16, 2020 suspension of certain provisions of the Texas Open Meeting Act. This meeting of the School Land Board is held by video conference call as authorized under the government code. Access to the meeting by members of the public was published in advance in the Texas Register in accordance with the Texas Open Meetings Act. Any member of the public who wishes to address the board on a matter within the authority of the board should do so right now and indicate in text or via Q&A section on your Zoom board with Corey if you would like to provide some public comment. I, the chairman, can limit the length of time available to members of the public. Seeing that we have a quorum and those in attendance from our last meeting, which was held on March 12th, I will ask the board to review the minutes from that meeting, and assuming no questions, comments, or concerns at this time, I could entertain a motion to approve the minutes for the record.
So moved to approve. Second.
Motion is made, seconded, and carries unanimously to approve the minutes from our last meeting. Next item on the agenda is the consent agenda. I've been advised that item 2A2, the Marathon Oil lease, has been pulled from the consent agenda. Other than that, I'm not aware of any other changes. And after the board has had a chance to review it, and assuming no concerns, conflicts, or questions, I could entertain a motion to approve the consent agenda as posted.
I move to approve.
Second.
A motion is made, seconded, and confirmed unanimously to approve the consent agenda as posted. Items were a little bit different today in that items 3 through 9 and 12 will be discussed in executive session. Item number 10 and 13 will be considered only in open session, but we will enter into executive session right now to consider those matters that I've outlined. We'll do so under Chapter 551, Subchapter D, Section 551.071 of the Government Code for discussion consideration regarding pending or potential litigation, also contemplated litigation and or settlement offers, and received attorney advice and counsel related to those items 3 through 9, 11, and 12. We'll also enter into executive session under 551.072 for discussion consideration regarding purchase, sale, exchange, lease of real property related to items 3 through 9, 11, and 12 on the docket. And following executive session, we will reconvene in open session. I will ask for relevant staff that are briefing the board and members of the board to just basically hit mute and also close your screen off and then dial into the conference line that we provided in your preparation materials for today's meeting. Looks like we're recording. So the open session of the April 6, 2021 School Land Board meeting will now resume with item number 3. Before we jump into staff presentation on the issue, I just want to advise the board that Mr. Hanga is available to address any questions from the board regarding this item.
Good morning, Commissioner, board members. Ken Mills, Director of the Oil and Gas Section in the Office of General Counsel. Item 3 is a request by Diamondback E&P for a waiver of certain penalties. Staff recommends a resolution of this item as discussed in executive session. I'd be happy to answer questions.
Any questions from the board of Ken or Mr. Hanga?
None here.
Hearing none, I could entertain a motion to confirm staff recommendation.
I'll move to approve. Second.
Motion is made, seconded, and carries unanimously to approve item number 3. Thank you, Mr. Hanga, for jumping on as usual. Item number 4, I believe Ken will be presenting this issue on Upcurve Energy.
Yes, sir. Just for the record again, Ken Mills, Director of the Oil and Gas Section in the Office of General Counsel. Item 4 is a request by Upcurve Energy, again, for the waiver of certain penalties, and staff recommends resolution of this item as discussed in executive session. And I'd be happy to answer any questions.
Any questions from the board?
This is Michael. I move to approve the staff recommendation.
Second.
Motion is made, seconded, and carries unanimously to approve item number 4. Next on the agenda is number 5.
You're muted, Amber.
Thank you. Good morning. This is Amber Long with Asset Management. Staff recommends approval of the sale of tax foreclosure land in Brewster County per the terms discussed in closed session. Any questions?
No, I'll move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 5. Thank you, Amber. Next item on the agenda is number 6.
Good morning, Amber Long, Asset Management Division again. This is a tax foreclosure in Harris County, and staff recommends approval of the disposition of this property per the terms discussed in closed session as well. Any questions?
No, I'll move to approve.
I'll second.
Motion is made, seconded, and carries unanimously to approve item number 6. Thank you, Amber. Next item is over in Fort Bend County, number 7.
Good morning, David Wells with Asset Management. Staff recommends approval of docket item number 7 per the terms discussed in executive session. Happy to answer any questions.
I'll move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 7. Next item is number 8 in Grayson County.
You're muted, Anita.
Sorry. Good morning, Anita Dabney, Asset Management. And staff in this case recommends that the School Land Board approve the adjusted sales contract terms as presented to the board for the property located in Grayson County, Texas, being in the best interest of the state and the permanent school fund. I'll be happy to answer any questions.
It's Michael. I move to approve.
Second.
Thank you.
Thank you, Anita. Motion is made, seconded, and carries unanimously to approve item number 8. Item number 9, feel like we're touching all of Texas here, Johnson County.
Susan, you're on mute.
Good morning. This is Susan, Asset Management. Item number 9 is an application to purchase vacant land in Johnson County, 19.927 acres, file number MA 77790. Staff recommends approval of this transaction under the conditions and terms as discussed in executive session. Any questions?
Any questions of Susan?
I move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 9. Number 10 is proposed modifications to the PSF investment policy statement.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer of the General Land Office. At the March 25th meeting of the IEC in conjunction with Townsend Group reviewed, as we usually do every year, the TexGlo PSF investment policy statement and unanimously approved the following proposed modifications to the policy to present for your approval. On page 2, there are a couple of changes. The primary one is we are recommending that we modify the asset class allocation targets to decrease the target for the energy sector in the portfolio from the existing 35% down to 31%, and to correspondingly increase the target for infrastructure sector of the portfolio from 32% to 36%. And that leaves the real estate sector unchanged at 33%. The reason for this is we want to reduce the volatility in the portfolio that's related primarily to volatility in global oil prices. As you know, those prices have been very volatile for quite a period of time, particularly in the last year. We expect that volatility is going to remain in the market for some time. And so in order to do that, we want to reduce the exposure. And actually, we expect that to result in a slightly higher expected annual net return on the portfolio. The current composition, we project about an 8.21% net return. But with the new allocation, we expect that would increase a couple of basis points to 8.23%. But it also would slightly lower the standard deviation, which is a risk measure for the portfolio. Currently, we project that at 14.75, and this new allocation would reduce that to 14.65. So that's the primary change in the policy is altering those targets. Also on page 2, we just make a slight clarification that the portfolio's return objective, which is net of fees, is also measured against a benchmark that is also net of fees. On page 4, we've revised table 1 on that page just to reflect the changes to the asset allocation targets that we just noted. And then on page 5, a couple of minor changes. The geographic diversification target is currently 85% for US, Canada, and Mexico, and 15% international. We're recommending that we change that 85 to 90 and reduce the international target from 15 to 10. The international component of the portfolio is around 5%. It typically stays around 5%. I'm not sure that we've ever reached 10%. 15% is just going to be very difficult to do. So we're recommending that we change that to 90-10. And then the final change is just a clarification regarding new co-investments. And all we're doing here is clarifying that the limit on a new single co-investment is no more than 5% of the total portfolio NAV, but that applies only to the initial capital commitment to that co-investment. In other words, if the board wanted to increase it above 5% at some point in the future, it would have the flexibility to do that. This is a voting item, and that is all the proposed changes. I'm happy to answer any questions.
Any questions from the board on suggested changes to the investment policy targets?
Just a quick question, Rusty. Do you happen to know what the energy limitation is for the SBOE component of the private equity component for the SBOE? In other words, these are very round numbers, and I apologize for being so rough with my round numbers. But the way I've always thought about what's under your management is we have plus or minus $4 billion of private equity, plus or minus $4 billion that's managed in the liquid account fund, and roughly $3 to $4 billion that is the value of our royalty and real estate fund. So total overall portfolio, roughly, again, very broad numbers, 12 billion. So when you're talking about of the private equity portfolio today that is plus or minus around 4 billion, you want to reduce the equity exposure concentration by roughly 4%, from 36 to 32 or 35 to 31, I think is what you said. Is there an equivalent number that we should know about, just for whatever it's worth, because it is one beneficiary on the SBOE side in terms of their private equity portfolio in terms of energy concentration?
So let me answer that by saying I don't know what the private equity energy concentration is in the PSF portfolio that's managed by TEA on behalf of SBOE. From a public standpoint, obviously they're indexing equity indexes that have some component of energy.
Right.
If they're close to the components of that index, they're probably around 6-7% of their benchmark.
Right.
We compare whether or not there are any overlap in investments that we're making versus investments they're making on a specific basis. That overlap is very, very, very minimal. I just can't say to what extent they have energy exposure on the private side. I will say that the there are 2 new members on the Investment Advisory Committee. One of them is the CIO at the Permanent School Fund, Holland Timmons. So he was involved in this discussion,
Mhm.
and he didn't raise that as an issue or concern from his perspective.
Okay.
Rusty, this is Michael. I looked ahead to item number 13, the chart that shows our current composition and the RESPA, and we're actually at about 30% right now in energy. Isn't that correct?
Within our portfolio, the
Yeah.
portfolio that we manage, yes. Todd was asking about the overall portfolio, including the SBOE managed assets.
Right. I was just pointing out that we were already below that target. So we're adjusting the target to be more in line with where we are at present.
Well, to be more in line with where we are, but also to limit going forward, because the reason it's as low as it is now is because of the precipitous drop in pricing.
Values, yeah.
Before the pricing decrease, we had a target of 35%, but we were from NAV perspective, we're around 39%. So those numbers are strictly reflective of the current decrease in pricing in the market. And like I said, it's not so much the exposure, it's the volatility that we're trying to mitigate here.
Thank you.
Great questions. Any other questions from the board?
And this is an item that we're voting on today.
This is a voting item.
All right.
I'll move to approve.
I'll second.
A motion is made, seconded, and carries unanimously to approve item number 10. Thank you, Rusty. Next item is number 11.
Thank you, Mr. Chairman. Members, approval of this agenda item would constitute your approval of an increase in the amount of an existing investment by TexClo on behalf of the Permanent School Fund in Lion Industrial Trust. The IAC is recommending that TexClo increase its existing $200 million capital commitment to Lion on behalf of the Permanent School Fund by an additional $100 million, which would result in a total commitment by TexClo to Lion of $300 million. Just basic information, the LIT was formed in December 2002. It is a core plus open-end real estate investment trust. It focuses on acquiring or developing high-quality bulk distribution and warehouse assets in primary U.S. markets that benefit from proximity to large population bases and major transportation nodes with well-developed infrastructure. Lion is part of the Clarion Partners U.S.-focused real estate operating platform, and it's one of the few pure-play industrial funds currently available to investors. Our relationship with Lion began in 2017 with an original investment of $75 million. In 2018, you increased that investment to $200 million. Another expansion of that investment offers us an opportunity to enhance our position as an LP in one of the best performing private equity industrial real estate funds in the United States, capitalizing on the continued compelling prospects for the industrial sector caused by structural changes in retail distribution driven by e-commerce. Investment management staff conducted due diligence and analysis on the proposed expansion with Lion through meetings and discussions with the Lion team and the Townsend Group over the past several weeks. In addition, the Lion team made a detailed presentation to the IAC on March 25th. In conjunction with this ongoing discussion, review, and analysis, investment management worked with Townsend and legal counsel to ensure that the investment fits within the framework of the investment policy statement and is in the best interest of the Permanent School Fund. Therefore, IAC is recommending that you approve an increase of $100 million in your existing investment in Lion Industrial Trust, resulting in a total investment of $300 million by TexClo in Lion. And I would just note that the approval of this transaction is, as usual, contingent upon investment management's completion of the negotiation and finalization of the legal documentation associated with this proposed additional investment. I'm happy to answer any questions.
Any questions from the board at this time?
So I think I know the answer, Rusty, but how many members are currently on the IAC?
5.
And we're all present when this went before the IAC?
Yes, sir.
And was it a unanimous vote for approval?
Yes, sir.
Okay. And Jeff, after the call, if you'll send me a list of who's currently on the IAC.
Sure.
This is Michael. I'll make a motion to approve the additional investment.
I'll second.
A motion is made, seconded and carries unanimously to approve item number 11, investment in Lion Industrial. Next item on the agenda and our final voting item is a potential investment in the USAA Housing Platform Fund.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer. Approval of this item would constitute your approval of an investment by the GLO on behalf of the Permanent School Fund in USAA Housing Platform Fund, LP. The IEC is recommending that TexGlo invest $300 million on behalf of the PSF in USAA Housing. The fund is a newly formed $2 billion open-end commingled private equity fund sponsored by USA Real Estate Company, which I'll refer to as USAA Realco, seeking to capitalize on robust U.S. demographics and strong long-term demand for rental housing. USAA Housing intends to invest primarily in multifamily assets diversified across the premium, middle market, and workforce sectors. That'd be 80 to 90% of the portfolio. And then another 10 to 20% would focus on alternative forms of rental housing, including single-family rentals, located primarily in East Coast, West Coast, and Gulf Coast markets. TexGlo has a longstanding relationship with USAA Realco that began in 2007 and has resulted in total original capital commitments of $735 million across 2 funds and 3 separate accounts. Investment management staff conducted due diligence and analysis on the proposed investment in USAA Housing through meetings and discussions with the US Realco team and the Townsend Group over the past year. In addition, the US Realco team made a detailed presentation to the IC on March 25th. In conjunction with this ongoing discussion, review, and analysis, investment management worked with the Townsend Group and legal counsel to ensure that the investment fits within the framework of the investment policy statement and is in the best interest of the Permanent School Fund. Therefore, the IEC recommends that you approve an investment of $300 million by TexGlo in USAA Housing Platform Fund, LP. And of course, your approval is contingent upon investment management's completion of the negotiation and finalization of the legal documentation associated with the proposed investment in USAA Housing. I'm happy to answer any questions.
We had a good discussion on this, and I would move to approve.
Was that Todd?
It was.
Okay. I'll second, but first, Rusty, again, 5 members present at the IAC, and it was unanimous at the IAC.
Correct. All members present, unanimous consent, unanimous approval.
I second.
Motion is made, seconded, and carries unanimously to approve item number 12. Final item on the agenda is Rusty's quarterly investment reports and non-voting item.
Thank you, Mr. Chairman. Members, as the commissioner mentioned, this is a non-voting item. I'm pleased to present you with a quarterly investment report of the Permanent School Fund investment portfolio for the period July 1st, September 30, 2020. The performance measurement calculations and the statistical data that are in the report were prepared by State Street Bank and its private edge group, which are the custodial, accounting, and performance measurement agents for the portfolio. Starting with an executive summary, I'll focus a little time on sort of the macro conditions for the economy as a whole And on the sectors that we invest in, third quarter US GDP dramatically increased at an annual rate of 33.4%. Of course, that followed a decrease of 31.4% for the second quarter of 2020. That increase in GDP reflected continuing efforts to reopen businesses and resume activities that were postponed or restricted during the second quarter due to the COVID-19 pandemic. The U.S. unemployment rate ended the quarter at 7.8%. That was down from 11.1% at the end of the second quarter, and again reflects efforts to mitigate the economic impact of the pandemic. As far as the Fed is concerned, following a series of actions taken in March of 2020 to decrease its target Fed funds rate from a range of 1.5% to 1.75% down to a target range of 0% to 0.25%. The FOMC indicated at its September 20 meeting that it would maintain that target rate range until, quote, labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time, end quote. In addition, FOMC reaffirmed the continuation of their balance sheet normalization program, which they had launched in October of 17. They also stated they would continue monitoring the implications of incoming information for the economic outlook, including public health information and global developments. And they would use whatever tools they needed to as appropriate to support the economy. In addition, they indicated they would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee goals. As far as commercial real estate is concerned, the commercial real estate market is measured by the NCREIF Property Index, NPI. It returned to 0.74% for the quarter. Its trailing one-year return was 2.01%. That turnaround, if you'll recall, the quarter before, it was down almost 1%. That turnaround was almost exclusively related to the strong performance of industrial warehouse properties. Overall transaction flow continued to be depressed. There were only about 50 sales during the quarter. And although that was higher than the 30 sales in the previous quarter, it's still well below the average of 100 to 200 sales per quarter. That results in continuing challenging price discovery environment for appraisers and obviously creates less liquidity for investors. As far as the returns on the individual sectors in the NPI index, hotel was down dramatically, down 4.17% for the quarter. Retail was down about 0.5%. Apartments were up about 0.5%. Office was up 31 basis points, and industrial continued its torrid pace. It was up 3.04% for the quarter, easily once again the best performing sector. And again, that's due to continued strong performance in industrial warehouse space. On the energy side, WTI spot prices averaged $40.89 a barrel during the third quarter, but they ended the quarter just slightly over $40 at $40.05, which was a 2% increase from the second quarter ending price. Consistent inventory draws and near perfect OPEC plus compliance helped establish a floor for near-term oil prices, but the continuing inventory overhang, depressed air traffic demand, ramping COVID cases, and trade tensions with China limited any near-term upside. The market expected to continue to rebalance during the fourth quarter as domestic CapEx and shale production continued to fall and steep decline rates offset the return of curtailed production volumes. At the end of the third quarter, most analysts expected WTI prices to remain range-bound in the $40 a barrel range through the end of the year, with $45 a barrel as a potential upside market. On the gas side, Henry Hub natural gas spot prices averaged $2 MMBTU during the third quarter, but ended the period at $1.66. It was about 6% below the second quarter ending price. Swelling storage inventories held prices down during the summer, but subsequent to quarter end, gas prices rebounded and the winter 2020 to 21 natural gas strip deck was around $3 per million BTU, reflecting stronger U.S. LNG export economics, hurricane-related Gulf of Mexico shut-ins, and Appalachian natural gas shut-ins. Many analysts believe this jump in natural gas pricing could continue through 2021. In fact, some are calling for natural gas prices in 2021 around $4 per million BTU. That bullish thesis is primarily driven by the spring 2020 COVID oil crash, because associated gas fell steeply alongside the oil production, and that steep decline in natural gas production should cause a massive imbalance in U.S. gas supplies in 2021. Turning to the performance measurement on page 2 of the report, total NAV at the end of September 30 was just under $4 billion, 3.995 billion. The portfolio itself was 3.903 billion, 98%. The cash equivalent investments were $92 million. Looking at portfolio performance, focusing on the gross returns without cash, the quarter for the portfolio was up 10 basis points, 0.1%, well under the benchmark that was up 1.39%. Real estate sector was up 1.3% for the quarter. Infrastructure was up 1.6%, but energy was down 2.7%. And that accounts for the underperformance for the period. The 1-year return on the portfolio, again, reflecting continued weakness in energy, was a minus 13.85% versus 3.72% on the benchmark. The 1-year sector returns for energy was a minus 36.12%. Infrastructure slightly down, minus 1.11%, and real estate was up at 3.22%. 5-year return was 8.01% versus 5.89 on the benchmark. And the 10-year return was 12.53% versus 8.55 on the benchmark. So still significant outperformance on the longer term measurements, which don't have that volatility from energy associated with them. I would point out that the policy return, as you know, is a 5-year net of fees return. And so that return, that 5-year net of fees return on the portfolio at the end of the third quarter was 5.91% versus the benchmark, which was 3.55%. So portfolio benchmark target policy return is significantly above the benchmark, over 235 basis points. Looking at page 3 of the report, for new investments, the board approved during the quarter $100 million expansion of an existing $200 million capital commitment to INCAP Energy Transition Fund 1. That's indicated on page 3. And then subsequent to that, there were no new capital commitments approved during the following quarter. As far as allocations by asset type, which are on page 7, the NAV based, and page 8 for NAV plus unfunded commitments. On a purely invested basis, the allocation of real estate at the end of the third quarter last year was 31% versus a target of 33%. Infrastructure was at 39% versus a target of 32%. And energy was at 30% versus a target of 35%. And of course, that all is reflected, or at least those changes in the amounts versus targets are all a reflection of the price volatility in energy, which we've talked about several times today. Over time, those allocations will become more aligned with the allocation targets as the board makes new commitments in the various sectors and as more of the existing unfunded capital commitments actually become funded. On page 8, I show the exposure on an NAV plus unfunded commitments basis. And on those basis, real estate is at 27% versus 33% under target. Infrastructure was at 39% versus 32% target, and energy was at 34% versus its 35% target. Currently, on a geographic diversification basis, which is on page 11 to 12 of the report, portfolio is about 95% allocated to US and about 5% to international. And as we discussed earlier, we are changing those targets to 90-10 with the changes that you adopted earlier. As far as investment managers exposure is concerned, it's on page 13 to 14 of the report. On a purely invested basis, we're well diversified across a platform of 25 different managers. The policy statement limits the exposure to any one investment manager to no more than 20% of the total portfolio. At September 30, 2020, we're well within that range. The top 5 highest exposures are InCap Flat Rock Midstream at 11.2%, USAA Equity Advisors at 9.7%, Macquarie Infrastructure Partners at 9.2%, InCap Energy at 6.6%, and Clarion at just over 6%. The co-investment vehicles are grouped by manager and presented separately. Those exposures were InCap Flat Rock Midstream at 8%, followed by First Reserve at 5.1%, and BlackRock at just over 4.5%. That concludes my presentation. As the chairman mentioned, this is a non-voting item, but I'm happy to answer any questions you may have.
Any questions or comments from the board?
Rusty, this is Scott. I'm probably looking at this wrong, but on page 10, am I seeing that real estate's 45%? And I'm trying to reconcile that to page 8, and maybe those are apples and oranges.
That's a different valuation metric. That's a net market value. That's not the same as net asset value.
Okay.
So I can talk to you about that offline
No,
and tell you what the difference is.
Yeah, I think I understand the difference. I just didn't see that. Okay.
Any other questions? Thank you, Rusty, for the presentation. This being a non-voting item and no further business before the board, we can hereby adjourn. Thank you, everybody.